All right, people in the class, welcome to the session. Welcome to this amazing batch for CA Final AFM for the attempt of November 24 and onwards, and CMA Final SFM for the attempt of December 24 and onwards. Everyone, very good morning. So let us wait for a few minutes. Let everyone join in, and then we proceed. Kindly confirm if you can see me, hear me. Let me check my audio actually. Just hold on for a second. So as I can see myself, I can hear myself. So everything seems to be all right. Okay. So let's wait for a minute or so and then we start. Everyone. Rakesh, you can see me, hear me. Very good morning. Sahil, all fine. That's great. Amazing. How are you guys? Halchal, everyone? All good? All right, all right, all right. So this being the lecture one for this full English batch, and let me tell you, this batch is going to have an amazing experience for you guys. You will experience, sir, how the core of finance is being learned. How do you understand everything using your common sense so that you don't have to mug up even a single thing? You are going to experience, sir, how does it feel to refer to the best notes in the industry. I will take you through the notes and you will realize how important it is to have such a notes that revision becomes literally quick. And you are going to experience what it means to attend live in a class, the level of interaction we will maintain. You will realize that you won't actually realize that when would your 3 hours quickly pass. All right, so let me tell you, this is, as I say, this is going to be an amazing experience. So what is going to be the approach for this batch? Let me share. Yes, all right. First thing, let me share my screen so that I can take you to certain things. All right, great. So all those who are registering to this batch, they are going to receive two copies, two different books of the hard copies, like two hard copies of two different books. First OutNotes and second OutScanner. Let me clear a few things. OutNotes are the concepts notes and OutScanner is the question bank. OutScanner also have the concepts or the content from theory topics, whereas OutScanner is only the question bank for practical topics. All right. In terms of coverage, let me specifically tell you in just one line, beyond these books which you have received, beyond these books, you won't have to refer to even a single question or a single concept from anywhere else. Right? This book is completely updated till the attempt of May 24, which means no other concept, no other question is to be referred. One more thing. In case of any further update, if institute comes up with any amendment or any updates, you all need to be connected through the Telegram channel and the YouTube channel, and that's all. All the updates will reach to you on time. All right, cool. Let me show you one copy of book that you must have received is this book called as OutNotes, right? This is the OutNotes. How is going to be the approach? Let me tell you. This is a semi-structured notes, right? These are semi-structured notes in which all the concepts, everyone in the class, we are going to study in the form of table, charts and diagrams, which means certain things have already been written, certain basic things have already been written. However, more important things, which are the formulas or which are the concepts to be applied in the questions, those things we will write down at our own in the space given at different places. This will, if you are consistent and if you are putting in efforts to make these notes with me in the class, let me tell you, you will have something amazing ready with you that is going to help you in the exam. Which means you will realize that the revisions literally become very easy because you don't have to read the text. Everything is written in the form of tables, charts and structures, making your revision very easy. Second, so these are the outnotes, which means all the concepts will be updated here. Then you have this book called as OutScanner. Just a second. One second, something has got updated. All right. Anyways. So this book OutScanner, everyone in the class, is the question bank and is actually the solved question bank. And let me tell you a few things very important about this book. First, it is comprehensive, which means questions from all past RTPs, MTPs, exam paper, study material which is relevant for you has come here. First thing. Second, I have tried to modify the solution in this book in such a manner that your marks won't be compromised, but your learnings will actually be very easy. Let me tell you, the same question the institute sometimes solve it this way, sometimes solve it this way. A student is really confused, sir, do we need to remember both the methods, or sir, I'm able to understand only one of the methods, or sir, how will I know which question will have which method? All such problems have been sorted. Now we are going to follow one standardized method which is the most easy, for which we will 100% get the marks, and also which is applicable to all the questions, right? Which means you don't have to worry about, sir, is the solution of this book will the solution of this book match with the institute or not. Everything is as per institute. However, at some point, if I feel that the solution of given by the institute is actually ambiguous, a lot of time, everyone, how many of you have literally observed, that there are mistakes in the solutions given by institute? Do you agree to it? Obviously. Isn't it our favorite job to criticize them? Everyone. I think this is the most relatable common point among us. Criticism towards them. Yes. So, a lot of times we know that solutions given by the institute are ambiguous. In that case, what do we do? In that case, I have given you both the solutions. First solution, which is logical, which will also be approved by your common sense, your knowledge, that okay sir, this is logical. And second solution that I've given is what institute has given. We will have both the solutions. I will clearly guide you at that in that question, which one do we need to follow. All right. So this is the solved question bank available for you. Few more things. Finally, before we start, let me tell you. First, since I've explained you about the book, what is going to be the approach? Sir, in the class, we will understand the concepts in real depth, right? We will literally understand the concept in such a manner that we will try to make sure you won't have to mug up even a single thing. So first, understanding the concept in the class and writing them down. Because if you write it, you always remember it. This is the flow. Second, sir, from every chapter, we will do few questions in the notes, as in we will try to write them. I will either make you people write, or I will write it myself and you also write, so that we get a comfort over the presentation as well. After those basic questions are done, for the rest of the questions, we will solve them. We will obviously understand the question in real depth. We will solve the entire question on the calculator itself, so that we can save on the time which gets consumed while writing. If we save that time, we would be able to complete the batch in a shorter time, literally without compromising the quality. Which means, let me clearly tell you, in fact, you know what will be your level of understanding? You're not realizing it. You know what will be your level of clarity or confidence in this subject? It will be beyond that 300-hour regular batch. We will cover up the things, I will share you certain things which will be beyond that 300-hour regular batch, obviously. But how is that possible in 200 hours? Because we will end up saving time in writing the things, and we will focus more on learning the things. All right? All right. Next. So now you're clear with the approach for the concepts and approach for the questions. Last thing. If you look at the sequence here, this is how the index by the institute has been given. All right. For example, institute has given this chapter called as securities valuation, right? Institute has given this chapter called as derivative analysis and interest rate risk management. But we have modified the sequence given by institute, right? For example, If you look at the chapter 5 from the study material, which is securities valuation, you will find there are 4 securities in that: preference share, bonds, money market security, equity valuation. Right? An institute has one more chapter, which is chapter number 13 in their book, which is business valuation. Now, let me tell you the thought process needed for equity security and the entire chapter of business valuation is very same, which is why we have clubbed these two things to make it equity and business valuation. And thought process for rest of the 3 chapters of security valuation, needed thought process is same, which is why we have merged all of them into a single chapter called as fixed income securities. Meaning to say, the way you are going to cover up the things will look different from institute, but that does not mean you are lacking or you are missing out on anything. I have made a chart with complete clarity why your book will look different and how are the chapters covered. For example, derivatives and interest rate risk management. Similar thought process, both of them will be covered in our book in a single chapter called as derivatives and interest rate risk management, right? Which means in our book you will find the index in this manner for which basics of AFM, obviously not there in institutes material. We are going to build certain basics, but beyond that, all these practical chapters, as you can see, are here, and rest of the theory topics are here. All right. Format of exam, if I have to tell you, so that you realize the importance of theory is also important. So obviously, it being the first day, everyone, it being the first day, it will consume a few minutes of us, right? But are needed for you. Because after that, we are not going to talk on such things about the exam pattern, book approach, everything. Let everything be very clear to you all, and then we can start full-fledgedly. Who's here? Keshav, good morning. How are you? Sahil, what did Sahil say? Multiple people create books, questions, so multiple methods. Yes. And we want to avoid that confusion, Sahil. So that a single type of method we can follow to any question which is there in the book and which may come to us in the exam, right? Which we might have to face in the exam. All right. Great. Exam pattern, very basic. I know there will be a lot of people who don't belong to who are not doing it for the first time, right? So this batch actually is suitable for both the category of students. Those who are doing it for the first time, those who are doing it and they have taken the regular batch, but they have missed it or they didn't get it or it didn't boost the confidence, they didn't understand, whatever, right? Simple approach for the paper. You have you have 15 questions of 2 marks each, which means 15 MCQs of 2 marks each, which means you have 30 marks dedicated for your MCQs, which means 70 marks will be rest of them. 70 marks, for 70 marks, there will be total 6 questions, out of which you have to do 5 questions, where each question will be of 14 marks. So out of 6, if you do those 5 questions, right, of 14 marks each, you will get 70 marks from there. What will be the breakup of 14 marks? Although it is not official, but it has been observed from May 24 exam paper that first, you will have one question of 6 marks, one practical question of 6 marks. Then you will have one practical question of 4 marks, and you will have one theoretical question of 4 marks. It has generally been the observation so far. This is how you have the breakup of entire 100 marks you will have to face in the exam, which means for this 4 marks, this is the format for CA final AFM. I'm saying for CMA final SFM the format is quite different. We will talk about it later. Sir, these 4 marks for every question. In this 70 marks, you will have to do 5 questions. And in all those 5 questions, there is a probability, strong probability of one question being of theory. Which means, do you realize these theory topics you cannot ignore? They are very important. But the question is it really important to cover the entire theory? which is huge. So don't worry at all. Over the time, I will guide you on these aspects as to how to cover theory, which theory is important, and so on. All right. So I think we are now all set to start with the session, right? So those who have not received the hard copies, obviously after you register in 1 or 2 days, the books will get dispatched. Those who have received it, we can start to write it right away. All right. So starting with the very first chapter, which is basics of financial management. Everyone, are we all set? Can we proceed? Just hold on for a second. Yeah. Please tell me, are we all set? Can we proceed to have this discussion? Everyone. Let us, people, get started. Starting with the basics of financial management. In the basics, we are going to understand certain ratios. Basic ratios, you have covered it at some point in inter. Okay, all these ratios we are summarizing at this place here so that you don't have any confusion. All of us are to the same base before we take it ahead. All right, starting with EPS, earnings per share. You'll obviously know it. Sir, it is the total earnings divided by total number of shares. This is the formula. What is the understanding? This is the formula. I'm not asking for the formula, I'm asking for the understanding. Earnings per share. That on a per share level, on a per equity share level, common equity share level, what is the earnings made? Formula obviously becomes earnings that belong to equity shareholder. Means, let me give you the extract of P&L, right? This is the extract of profit and loss account. Suppose you have profit after tax, right? So we will call profit after tax as PAT, right? So you have PAT or you have EAT, earnings after tax, right? Which means this comes after deduction of interest and everything. From this PAT, if you deduct the dividend of preference shares, so obviously in the PAT we have a claim of both the shareholders, preference dividend and preference shares and equity shares, right? So if I deduct from it the claim of preference shareholders, which is preference dividend, obviously can I say rest of the earnings will entirely belong to equity shareholders, right? So which is why we call it EAES, earnings available to equity shareholder, which means this is the profit left for which can be distributed to all the equity shareholder, or this is the profit on which only equity shareholder has the claim. But this is the total profit earned by all of them. So how much will be the profit earned by one share or every share? The formula of EPS will be earnings available to equity shareholders divided by number of shares. This formula will give you how much is the per share earnings. Easy. Next. So obviously, we are not going to spend so much time to understand these basics. है ना? However, at any point, if you are stuck, you have all your rights to ask even the silliest or the smallest of the doubt. Because actually, no doubt is silly, right? You have all your rights to ask whatever you want to ask. Am I clear? Please, this is needed. At any cost, you don't have to compromise with the learning, with the understanding. No hesitation, freely ask whatever you want to ask. Done. Chaliye. So EPS is clear. Next is PE ratio. Price to earning ratio. I think the name itself has the meaning. What is the ratio of earnings that a company make and the price which is there in the stock market for the share of that company? For example, a company distributes the EPS of rupees 2. A company not distribute makes an EPS of rupees 2, has an EPS of rupees 2. However, price of the company in the stock market is 30. So 30 is market price per share MPS. 2 rupees is earnings per share EPS. And P ratio in that case becomes 15 times. Sir, why do you use the word times? Times means Price is actually 15 times the amount of earning. If earning is 2, price is 15 times of rupees 2, which is rupees 30. Alright. So what becomes the official formula of it? The formula becomes MPS divided by, just hold on for a second, don't write, hold on. P ratio is equals to price, which is MPS, divided by earnings, which is EPS. Sir, what is the use of this ratio? That we will learn. At this point, we are focusing on learning the meanings. How will they be used will automatically be covered when we come to those questions. Alright, chaliye. Next one. Regarding dividend, what are the possible ways in which we may be given we may be given the details in the question with respect to dividends? Let me clear. This is earnings per share, which means on a per share basis how much has been earned. Similar to that is dividend per share, which means on a per share basis how much dividend has been distributed. Common sense remains the simple. Here I was considering the total earnings in the numerator divided by number of share in the denominator. Similarly, this time it will be total dividend paid in the numerator divided by number of shares in the denominator. This is going to give me on a per share basis how much dividend has been distributed. Alright, so this is obviously in maybe rupee terms, ya fir dollar terms, in whatever currency, but it will be in absolute terms. Right, now you should be able to interpret the dividends given in percentage terms. There are 3 ways in which the dividend information may be given to you in percentage terms. Very simple. First is dividend rate. Dividend rate is always as a percentage of face value. Please try to understand it very easy. Suppose I say that company, everyone in the class, distributed a dividend of 10%. Company distributed a dividend at the rate of 10%. What does it mean? Sir, whatever is the face value of that, 10% of that face value is the amount of dividend. For example, if the company has a face value of rupees 100 each and company said the dividend is 10% or say 25%, which means dividend is rupees 25. Alright. So if I have to write it down, I can write it down in this manner. Just hold on for a second. Let me first of all present it and then you people copy. Hold on. So if I want to find out DPS in that case will be face value. Let me not write this. Correct. So if I have been given the dividend rate and if I have to find out the dividend per share, then obviously face value multiplied by dividend per share. Similarly, so we will actually try to write down all the basics in this chapter here so that we don't have any confusion with respect to basics. And if we have, we can come back to these pages or this basic chapter and revise all the things and clear our doubts, right? Next one, everyone, is dividend yield. Let me tell you, whenever you hear this word yield, what does the English word yield in general means? Yield means return. And a return which is always calculated on market price, right? In fact, I want you all to write it down. Listen to me carefully first. Sir, yield means a return based on market price. We will, in the entire curriculum, we will refer this word 3 to 4 times. And at all those places, Yield would always mean a return which is calculated on market price. So obviously, when you find out the dividend percentage, dividend as a percentage of market price, we call it dividend yield. So I think understanding will automatically create the formula. Can I say? Can I say? Dividend yield. The formula of dividend yield will be DPS divided by MPS, right? So how do I find out dividend yield, which is DPS divided by MPS? So similarly everyone, if I have to find out DPS, if I have to find out dividend per share, if I have been given MPS, and if I have been given dividend yield, multiplying MPS with dividend yield will give me DPS similar to this. So actually, why are these two formulas looking different? Because mathematically they have been presented differently. Let me present the first formula also in similar to second. Let me do an alternative presentation here, which will look like this. Sir, wait, hold on. Dividend rate means dividend is as a percentage of face value. See this. Dividend rate means dividend is as a percentage of face value, dividend yield means dividend is as a percentage of MPS, and dividend payout means dividend is as a percentage of earnings. Means that one second. How much is dividend or dividend per share as a percentage of earnings per share? Which means simply saying if I earn 10 rupee of EPS, of this 10 rupee, suppose I distribute rupees 6 of EPS in the form of dividend, which means automatically I retain 4 rupees in the form of retained earning. So what percentage of my total earning of 10 rupees has been distributed? Sir, 6 divided by 10, which is 60%, everyone in the class has been distributed. So 60% distributed, 40% retained. How much is payout ratio? 60%, which is as a percentage of EPS. So let me again introduce to you in conclusion the three terminologies. More than formula, what is important? Let me tell you. More than formula, your understanding is important. Everyone, formula you will automatically create. Let us understand what percentage of earnings I distribute is dividend payout ratio. For example, you have the earnings per share, and if you have the payout ratio, can you find out DPS? Obviously. Don't think mathematically. Obviously, sir, EPS into payout ratio will give me DPS, but that's maths. Apply understanding. Sir, if the company has 100 rupee of EPS, and company says that we distribute 20% of, or the company says we have 25% as our payout ratio, what does it mean? It means that company will distribute 25 or 20 whatever percent of its earnings in the form of dividends. Meaning to say 100 into 25% will give me 25 rupees of DPS. Easy. Similarly, interpretation of yield, that of whatever I invest, what you invest is obviously the market price now. Can you purchase a share at its face value? No. If you want to purchase a share, go to market. And what is the price in the market? MPS. So as a percentage of market price, how much is the amount of dividend? In percentage terms, how much is the yield I am getting back in the form of dividend? Is dividend yield. And obviously as a percentage of face value is dividend rate basic. I also want to explain one more thing related to payout ratio. Everyone, just hold on for a second. Let me have water. Just a minute. चलिए everyone. All right. So we were trying to understand payout ratio and retention ratio, which is quite basic. In fact, you have already learned it. Let me tell you what are these things. Sir, first thing, if you earn 100 rupee, suppose out of 100 you distribute rupees 25 in the form of dividend, which means think how much is retained. Rupees 75 is retained with the company. In percentage terms, can you tell me what percentage has been distributed? 25 rupee out of 100 as a percentage of earnings, you will have to tell me 25 out of 100 is distributed, means 25 is payout ratio, which means 75 out of my 100 rupee of earning is retained. Rupees 75 out of that 100 rupees which was being earned is retained, which means my retention ratio is 75%. Retention ratio simply means on a per share basis or whatever, on a totality basis, whatever, ignore these words, what percentage of earnings have been retained by the company, which means not distributed by the company's retention ratio simply. Yes, all right, let us write it down. So सबसे पहले लिखिए retain earnings. So sorry, I just used a very few Hindi words, kindly pardon, right? I wanted to say, let us start to write down retain earnings is equals to EPS minus DPS. From the earnings per share, if I deduct the dividends, distributed dividends per share, I get the retained earnings per share. Right? And retention ratio will be retained earnings per share divided by earnings per share. Retention ratio will be, one second, we don't need to use any red pen over here. Retention ratio will be retained earning per share divided by earnings per share. Very easy, very basic. The last thing which I think we should write down, which is a relationship between these two ratios. So obviously na yaar, one part of the earning has been distributed, another part of the earning has been retained, which means one is payout ratio, another is retention ratio, which means both of them are interlinked. What is the relationship between them? Let us write it down over here. Payout ratio plus retention ratio is always equals to 1 or 100%. Obviously, na yaar. If you distribute 40%, which means you retain 60%. So the sum of two will always be equal to 100% na. Or in decimal terms, it will be 1 na. Everyone. Right? This is such a basic thing, which means if I have the payout ratio of 40%, I can obviously find out the retention ratio as 60%. I can back calculate it. This is the relationship between two things. While explaining this, it just came to my mind that I should explain you something related to percentage, which is quite basic. But I think one might have missed it while doing, I think, 9th or 10th standard maths class. Do you people realize that, where should I make you people write that down? Chalo, write it down here. There are different ways you can, write down a number in percentage. For example, what can you write down 2% as? 2% can also be written as 0.02. Obviously, for example, 1000 rupees into 2% is how much? Sir, rupees 20. And obviously 1000 rupees into 0.02 is how much? Rupees 20. Meaning to say 2% can also be written as 0.02 and it can also be written as, one second, It can also be written as 200 basis points. Now, sir, what is this basis points? Let me tell you. It is a subunit of percentage. For example, 1 rupee has 100 paisa. For example, 1 kilometer has whatever, I think, 1000 meters. Similarly, 1 percentage is equals to 100 basis points. So obviously 2% will be 200 basis points. So basis point is a subunit of percentage, which means if someone says 50 basis points, feel what is he trying to say? He means to say 0.5%. Right? So I think we should write it down in the bracket over here, the meaning of it, that 1 percentage is equals to 100 basis points. These are three ways actually. In which, just a second, let me do some beautification work for you guys. Hold on. Surely. Done. Why did I explain this? If in case, because while solving many times we or institute might use the word percentage, sometime they might, for example, they want to say 40%, sometime they will say 40%, sometimes they will say 0.4. So obviously we will automatically get a sense of it through these concepts, basics. All right, so percentage understanding is done. Now talking to you people in the class about market cap. Market cap. So I think I would want to take you to the website of Let's Try NSE. Just hold on for a second. Let me share my screen. 1 second. Hold on, people. Wait, let me connect to. Oh, hold on. All right. Hannah, let me take you, for example, to the company TCS. I was wondering if I can get EPS over here. But anyways, we will have the needed thing. Chaliye. So that you don't have to literally very theoretically mug up the things. Obviously, you can see every share which is being traded in the market or the stock exchange has the share price. Sir, what is NSE or BSE? The stock exchange. Certain very basic thing so that you have these things in imagination. Let me tell you, even if I don't tell you these, you will learn these. But you will learn these in theoretical manner. You will have to understand through a story. Here you can see it. Yeah, if I have to explain you what a lion is, I can either tell you it is very strong, 4 legs, 1 tail, or I can show you the lion, which is very easy now. This is what I'm doing. I can show you what is NSE. So basically, if you want to buy, sell, where do you go? I want to buy, you want to sell, where do we go? Both of us go to stock exchange. I will tell I want to buy, you will tell you want to sell, and accordingly transaction will happen. So there are two such marketplaces where trading take place, NSE, BSE, which we call them stock exchanges, right? This is the share price, which means at this price one can buy or sell. On a lighter note, which means broadly you can say that 3855.65 is the price of share. This is MPS, right? Sir, where do I find the EPS of the company? FR people, I don't need to tell you where do you find the EPS of the company. Earnings per share of the company is found where? In the financial statements, you can find out the EPS. When you have the EPS, when you have this MPS, and when you have the EPS, can you find out the P ratio? Yes. In this case, they have themselves given the P ratio. What is adjusted P and everything, we won't get into the details of it. But yes, adjusted P, or ignore the word adjusted, just see the word P ratio of 29.82, which means let's assume let's assume 30 times. 29.82 means 30 times, for example. What does it mean? Means that for every 1 rupee of earnings which TCS gives which TCS earns, for every 1 rupee that TCS earns, people are ready to pay 30 rupees in its price. Okay, which means people are ready to pay 30 rupees if they want to earn rupee 1 from TCS. This is the value of TCS. Okay, sir, which means different companies will have different P ratio. Obviously, let me show you about NFI. But sir, surprisingly, why are you taking only IT companies? Because naturally somewhere that is in my blood. When I was working in equity research, so I realized that I did not introduce myself, right? I will do it later. I'll do it later. Okay. So I thought if you would be interested to know about my background. Okay. Are you people interested? Everyone? So okay, let me proceed for now. When I was working in equity research, after clearing my CA and CFA, and while pursuing CFA, when I was working, I was taking care of IT industry with my team. So what is naturally in my blood is companies like TCS, Wipro, HCL, Tech Mahindra, Infosys, all such companies. If you talk about P ratio of say 24 times, 23.72 is 24 times for the company Infosys, which means for 1 rupee of earnings, for every 1 rupee that Infosys earns, people are paying 24 rupees at its price, whereas for every 1 rupee that TCS earns, people are ready to pay rupees 30 at its price. Which means 1 rupee if you get from Infosys, you will give Infosys 24 rupee, and that 1 rupee if you get from TCS, you will give TCS 30 rupees. This is the difference. Sir, why is that difference? All those things we cannot cover in this small batch of 200 hours. This is all related to the learnings of financial modeling. Anyways, so I have taught to you these basics. Let me find if I get the yield as well over here. Hold on for a second. Chali, great. The next concept will be covered through this shareholding pattern. Let me come to next concept and show it to you here. See, we also have the amount of EPS, fortunately. For the year of 31st March 2024, 23, one second, we have it quarterly actually. If we want it annual, for simplicity, we can add it up. So these are the earnings for not for the year, but for the quarter. March 24, December 23, September 23, and Jan 23. Respective quarters, these were the earnings of 20, 15, 15, and 14.36 something. Alright. Obviously, for the purpose of EPS, what do you consider? Annual earnings per share. All the numbers that you will do in AFM are annual. Okay. Cool. So I think I will have to take you to the next topic. Just hold on for a second. And then again we'll come here. So that automatically you understand, sir, what is total market cap, what is free float market cap. This is what the next topic is about. Market capitalization, everyone. Please be here on this topic. We are starting the discussion. Sir, market capitalization. See, for every one share, what was the market price of TCS as we saw? Or say Infosys. For every one share, what was the market price of Infosys? 1496, right? And how many shares Infosys has in its balance sheet, or how many shares are there with the Infosys which it has issued, which may be trading in the stock market as well, right? So one share of value of one share is the market price per share, right? But what about the value of all the shares of the company? See, what is the value of company? What is the total value of company? The total value of company is represented by all its shares, right? Which means what is the total value of all the shares of the company? Which means value per share of 1496 multiplied by total number of share that company has. Simply saying, for example, just hold on. Let me check the number of share or I will create my own example. Simply. Chalo, see this. For example, let us first try to cover through it. Sir, suppose this company called as Just Dial, has 1000 equity shares, right? Where price per share is rupees 15, which means every one such share is traded in the market as rupees 15. So if price per share is 15 and company has 1000 shares, what is the value of all the shares collectively of the company? What is the collective value of all the shares of company? 15 into 1000 is 15,000. So total market cap is equals to, simple, total market cap is equals to market price per share into number of share, which means 15 rupees into 1000 is equals to rupees 15,000. Very easy, very basic. This is total market cap or full market cap. Now, what do you mean by, sir, free float market cap? Let me enter into the details. If you look at the breakup of this 1000 shares, let us find out who were holding these 1000 shares. When I looked at the shareholding of the company, I realized that 70%, which means 700 shares out of this 1000, 70% of the shares were held by the promoters of the company. Basically, those people who are the founding members of the company, who founded the company, right? Similarly, 300 shares out of 1000, which means 30% of the total shares were being held by people like you and me, which is public in general. For example, if you talk about Tata, if you talk about TCS, TCS is the company promoted by Tata Group. So certain number of shares of TCS are held by Tata Group and certain number of shares are held by people like you and me, public in general, right? Okay. Sir, total market cap means value of all the shares of the company, right? You know what is free float market cap? Free float market cap does not mean the value of all the shares of the company, but the value of only those shares. Listen to my words carefully, you won't have to ever mug it up. Sir, free float market cap is the value of only those shares which are freely floating in the market, which are freely trading in the market. Which means, sir, let me tell you, shares which are held by promoters, for example, Reliance shares which are held by Ambani's, those shares cannot be bought and sold in the stock market. Then shares which are held by you and me and public in general are being bought and sold. If you sell, I will buy, I sell, someone else will buy. It is not the shares of Ambani's which are listed on the stock exchange. Similarly, these 700 shares are not listed on stock exchange. They cannot be bought and sold through stock exchange. These 300 are bought and sold. So what is the total value of those shares which are not held by promoters, which are held by public in general, which are freely floating in the market? So it is actually market price per share into free float number of share, which is rupees 15 into 300 is 4500 free float market cap. Something very easy, very basic. All right, next. Sir, if I have the total market cap of 15,000, I know this is my total market cap of 15,000. Can I say of this total market cap, 30% is promoters and sorry 70% is promoter and 30% is general public, which means do I have an alternative way to find out the free float market cap? Yes. Whatever is your total market cap into free float holding. Let me tell you, these are not the formulas that you have to write down in the exam. These are not at all your formulas. These are common sense. You don't have to write these down in the exam. But if I don't write these words, it will be a numerical sum to you. I don't want you all to look at it as a numerical example or sum. It is simple understanding. So don't write these things down in the exam. It simply wants to say that, sir, if my total market cap is 15,000 and of that 30% is freely floating in the market, which means 30% of this entire market cap is owned by public in general, which means rupee 4500 is my free float market cap. These are the two ways in which you can find it out. If percentage terms data is given, apply this. 1 second. If data in percentage terms is given, apply this. If data in number of share terms is given, apply this. Yes, everyone. So this is what about market cap. Now I would want to show it to you here. See this. If you look at, let me show you TCS only. Because to be frank, I don't clearly remember with respect to Infosys other than Narayan Murthy family who are the promoters. Chaliye, see this. See this. Let us look at the latest data of 31st March 2024. Out of my total shareholding of 100%, whatever number of shares were there, out of 100%, how much are the promoters owning? 72%, around 71.77 of the entire company. Huge company. Can you imagine the size of TCS? It's huge. 72% of entire companies owned by the promoters, which includes Tata Group or group companies, right? And only 28.23% is held by people like you and me, public in general. All right. Let's try to look at the market cap. See this. Total market cap. This would be in terms of crores, na? Total market cap is 13,95,000 crores, which is why I said it is a huge company. 13,95,000 crores is the total market cap. But of that total market cap, around 10 lakhs is owned by 10 lakh crores of that market cap is owned by them. How much public in general owning? Free float market cap of 3,90,602 crores. This much rupee crores is the free float market cap, and only this is being of 390. Only this 390 is being traded, not the entire 1395. Are you understanding? This is what free float and everything is. 1 second. Huh? This I am doing not for you, but for my curiosity. Arey yaar, I need to go to RIN. Hold on. ठीक है. Just want to show you a small example. I know it is off the track. I know it is off the track. But just one thing I want to make you people understand. See this. This is Reliance, and simultaneously, let me open TCS. This a small example will, literally. Also, we have a very good comment from Muskan. Those who are watching the lecture, trust him blindly because the exemption is guaranteed. Muskan, very happy to see such comments from you all. Great, amazing. So those who are watching this, please be here. I just want to tell you a small example. Sir, what is the total value of the company TCS? As you can see here, TCS, what is the total value of the company? 13 lakh 13 crore, 13 lakh 95,000 crore, right? Similarly, what is the total value of Reliance? 19 lakhs 72,000 crores. Do you know what should be the most surprising thing? TCS is doing just one business of IT. TCS is doing just one business of IT, and can you imagine what is Reliance doing? Multiple businesses, right from retail, which means if you see the store of Reliance, Reliance Digital, Reliance Footprints, Reliance Trends, to telecom geo related business. I know it is being demerged, but to petroleum business plus online stuff, Reliance is into multiple businesses. Despite that, are you people not shocked that size of TCS is 1395, which means 14 lakhs crores, and relative to it, size of Reliance is just 19 lakh 72,000 crores, where the TCS has just one business and Reliance has entire business. Those who are watching, it is a task to you. Whenever you watch it, because obviously there would be a lot of recorded people as well, right? Whenever you watch this, try to think, try to do a research and get back to me with an answer. I'm not going to answer this question right now, but I hope you realize what I'm trying to say. Anyways, so moving back to the book, people in the class, we were actually trying to understand the concept of market cap, where I have literally shown you, no need to explain it now, what is total market cap and free float market cap. Now moving to certain ratios which are based on financial statements. As of now, we have discussed the things which were based on market as well. For example, price is based on MPS, has nothing to do with financial statement. It is there on the stock exchange. Similarly, over here, certain things were financial statement based, but prices were market based. Market capitalization is obviously market data based. Now I'm going to tell you the things which are based on financial statements, starting with book value per share. Starting with book value per share, very easy thing. Very easy thing. As per balance sheet. Acha, just hold on for a minute. Let me have water. Chaliye, let me tell you what I'm trying to say. As per balance sheet, if you want to find out the total claim of equity, as per balance sheet, the total claim of equity shareholders, how will you find out? Sir, first of all, as per balance sheet, the total claim of equity shareholders is called as equity shareholders fund. Equity shareholders fund. You can find it in two ways. First, you can go through the equity side. For example, you will say equity share capital, equity share capital plus reserves and surplus, which automatically includes retained earning minus. Suppose in the balance sheet there are certain fictitious assets or the debit balance of P&L, for example, unamortized or unwritten off preliminary expenses. Those, they are fictitious assets, right? So such things are obviously needed to be deducted. Hold on, don't write hold on. I'm going to change the color. Kindly pardon me for my spellings, okay? Chal. So this is one way to find out the total equity shareholder fund as per balance sheet. Another way, so here we went through equity side, like which means the liability side where we tried to add it up the capital. Another way we are going to follow is to go through asset sides. है ना? Just one second. You have to add up all the assets. So you have to add up all the assets excluding fictitious or let me write it down this way. All the assets excluding fictitious minus all the liabilities so obviously now everyone, if you have the assets, another way to find out the balance of equity in the balance sheet is add up all the assets. है ना? Imagine it over here. Obviously very simple. You have all the assets. Take the total of assets from which if you remove the liability part over here, then obviously whatever left in the balance sheet is equity because the total of balance sheet always matches. So from this total, if you go back and remove the liabilities, what is left? Equity is left, and that is what we are looking for, right? So all the assets minus external liabilities, but again from which you will have to deduct what? Hold on for a second, let me tell you. You will have to deduct again the fictitious assets, because when you consider all the asset, if you consider the total of assets, in that obviously fictitious asset and debit balance of P&L, which is there over here. Suppose you have plant machinery, property, plant equipment in whichever format examiner gives you balance sheet, right? Do you agree? He can also give you preliminary expense or debit balance of P&L over here. Obviously, those things cannot be considered because they are ultimately to be deducted from the balance of equity, which is why I say you take all the assets, from that remove these two assets and obviously remove the liabilities to find out equity, which means this ratio is as per books, that is balance sheet. As per balance sheet of the company, what is the total value of equity, right? Because as per market, what is the total value is called as market cap. But as per the balance sheet, what is the total value called as equity shareholders fund. Now, this total value, this total equity shareholder fund will belong to who? To all the equity shareholders. This total value will belong to all the equity shareholder, means on a per share basis. On a per share basis, how much is the value as per books? This is the total value as per books. Then on a per share basis, how much is the value as per books? Is book value per share. So if I want to find out something on a per share basis, what will I have to do? Simply that, sir, whatever is my equity shareholder fund, if I divide by number of share, total value as per books divided by number of share will give me per share value as per books, common sense, which is book value per share. Remember, this ratio is based on balance sheet, has nothing to do with the market. Correct? So if I have to create a small chart for your understanding, right? Just let me, don't write it down, huh? Let me create it first. If we find it sensible, we will write it down, else you don't write. All right? Just be here for a minute. Just be here for a minute. Let me create it myself first. So, chali. I think this is a small table. See, I know a tool to a lot of people it is quite easy and obvious. But still I would want to write it down because I have to teach keeping in mind not the best student in the class. Now understood why book value, CMP and face value are different. See this. As per market, the total value, everyone, is called as market cap that we have learned. And as per market, the per share value is obviously called as MPS that we have learned. As per books, the total value of equity is called as equity shareholder fund. है ना? And as per books, that per share value is called as book value per share. So these four terminologies should be very clear to you. One is as per market, another is as per books. One is on totality basis, one is on per share basis. Simple concept. Very easy, very obvious. Cool. Now, when I say as per books, obviously you'll have to go to balance sheet. When I say as per market, obviously we'll have to go to stock exchange and find out the prices, find out like know the prices. Cool. This is also fine. Now I want to teach you. Acha, let me tell you one more thing. You know what? You must be wondering, sir, how would I know what is BVPS, MPS, ESHF after I? At the time of revision, how would you know? Let me tell you all these. What do we call it? Denotations. All these denotations have already been mentioned. For example, EPS mentioned, right? P ratio maintained. MPS, DPS, these rates have been mentioned. MCAP has been mentioned. Number of share, I will mention it right away. It is not mentioned. ROE is mentioned. BVPS is mentioned. Equity shareholders fund is mentioned. So if you observe these bold blue things, not just this chapter, in the entire FM, in the entire book, whatever subject, whatever topics are there, you will find these denotations which may actually be used even in the exam. These are official denotations which even the institute uses. All right. So one thing that let me write down for you guys is number of shares. ठीक है? Cool. Fine. These are certain basic things that you will have to read at your own. If it would be very important, which I need to explain, I will cover it in the class. If I find anything that which is there just for your reading, to give you a context, to give you a better clarity, I won't cover such things in the class. When you read it at your own at the time of revision, things will be clear to you. All right, chaliye, fine. So we are everyone clear with what is book value, market price per share, market cap, equity shareholder funds. Now I am going to explain you one ratio, which is return on equity, which is again as per books or balance sheet. If return on equity is as per balance sheet, everyone answer me this. Everyone in the class, you need to answer me this. If this is the ratio based on balance sheet, which numbers will be used? Numbers A or numbers B? Sir, obviously, since it has nothing to do with the market, it is based on books or balance sheet, these numbers should be used and not the one which are above. Easy, basic, obvious. Let me help you create the formula. This time everyone in the class, we will create the formulas, we won't remember them. Please tell me your common sense. What does your common sense say if I tell you that you invest 1500 rupees? Suppose you invest 1000 rupee, and by investing 1000 rupee you earn rupee 200 at the end of the year. By investing 1000 rupee you earn rupee 200. Can you tell me in percentage terms what is your return? Sahil, I saw your answer as B. Okay, rest of the people, even if you are not answering, I hope you are getting it. If you invest 1000 and get a return of 200, what is the return in percentage terms? I know everyone has an answer of 20%, right? What did you do? Which means, do you agree, in your brain set is already, in your brain set is already integrated that what should be the formula of return? Sir, it is 200 in the numerator divided by 1000 in the denominator. You know how you have created the formula of return. In the denominator, always and always remember, whenever I ask you to calculate any return, in the denominator will be the amount invested. In the denominator will be the amount on which return is to be calculated, and in the numerator will be the return earned on that amount. 1000 is what I invested. In the denominator will be what is invested. In the numerator will be what I have earned on that investment. Will always give you the formula of return. Common sense. So similarly, understand the name, return on equity. Return on what? Equity, which means return on the capital of equity. Please tell me, we have learned in the last 30 minutes, what is the claim of equity invested in the business? As per books, the amount invested of the equity in the business is called as equity shareholder fund. As per market, it is MCAP, but we don't need to consider it. We need to consider as per books. So if I want to find out return on equity, return on the capital of equity, so in the denominator will be the capital, right, will be the amount invested, called as equity shareholder fund. That as per balance sheet, this is the amount invested on equity. Sahil, it is not EAES. I'm saying about the denominator which is invested by the equity or claim of equity in the business is equity shareholders fund on a totality basis. I'm saying totality basis. Now you tell me, against this investment, as per books, tell me what is the return earned by the company for the equity shareholders, because in the denominator is the amount invested and in the numerator is the amount being earned. Please think and tell me. Think and tell me. If denominator is equity shareholders fund, numerator will be return earned on such fund, and you know the profit that belongs to only equity shareholder is called as EAES, earnings available to equity shareholder, and hence we say return earned on this capital is equity shareholders fund. Earnings available to equity shareholders. Earnings available to equity shareholders. Correct? Both the numbers are as per books, and this is the return earned by the equity shareholders, hence return on equity. Correct? You know what? The same calculation can also be done on a per unit basis. Sir, what are you saying? Let me try to explain. Just hold on. Just 1 second. See, first mathematically, then logical. Okay, Sahil. I did not realize that was the answer to that question. Now I got it. EAES. Sir, first think mathematically. If I divide by number of share, both the numerators and denominators I can divide by number of share. Sir, when you divide something by number of share, what do you get? Per unit claim. I get a per unit number, right? For example, EAES is the total earnings by equity shareholder. If I divide them by number of share, what do I get? Sir, I get per unit earning. These are total earning divided by number of share will give you per unit earning, which is called as EPS. Similarly, this is the total value as per books. As per books, the total value of equity is called as this. And if I divide it by number of share, then per unit, per share value as per books, per share value as per books, everyone is called as book value per share, which simply means ROE can be calculated in two ways and answer will be the same. First way, first way is on totality basis. First way to calculate ROE is on totality basis. Let me write it down over here. And another way is per unit basis. Simply saying total, see our common sense now. Even here it is common sense. In the denominator, you take the amount invested, and in the numerator, you take the return earned on such investment. Denominator is investment per unit, which is book value per share. So numerator is also return per unit, which is earnings made, like return earned per unit, which is EPS. So EPS divided by book value per share and EAS divided by equity shareholder fund, both of them are going to give you the same answer, and obviously you are all clear with the logic. Correct? Please tell me, everyone in the class, all my live students and all my recorded students, could I clearly convey to you? At any point, if you feel that the speed is quite low, so let me tell you, this is just a start. This is just lecture 1 of it. As we proceed, you will realize that, sir, kindly slow down. The brains have literally stopped working. This also might be the case. All right. Chaliye. So we are, everyone, set with this return on equity. Cool. Fine. Next one, let me plan for you what should be study. Hold on for a second. You know what? There would be certain other formulas as well. Sir, for example, what is return on investment? What is return on capital employed? Let me tell you, the things which we study here are generally applicable to almost all the chapters. However, there are certain formulas being used in specific questions, like the formula of, say, debt coverage ratio, formula of return on capital employed. Such formulas we don't study now. As and when we will come to those questions, we will study them and we will obviously write them down here. So for example, if you go to page number 8, if you go to page number 8 of OutNotes, we have this place here where we will compile all the ratio, all the formulas used across AFM, so that one day before the exam, if you have to summarize all these formulas, they are compiled, all of them at one place over here. All right. So whenever we will do those questions, we will write down the formulas used in those questions over here, making your life easy. Next one I think we should learn is regarding time value of money. I don't know what have you learned in the basics, everyone. What has been taught to you in the foundation. To be frank, lecture 1 is an extra lecture. It should not be there ideally. All these things which I'm teaching you, you should be done with it already at your inter level or foundation level. Anyways, but we need to make sure that from second lecture and onwards, when we really shoot up, All of us should be on the same page. When I teach to you the most technical things of AFM, one should never ask how to do this PV or how to calculate ROE or why have you taken book value in the ROE and not market cap. So that we don't face those questions at that point, we are studying such things in the basics over here. Alright, Chali, let us proceed to understand the basics of time value of money. Let me share with you people certain formulas. Let me give you the situation first of all. Everyone, hope you are sitting with a calculator in your hand. है ना? All these calculations happen on the calculator itself. Sir, I think I will have to also teach you how to do things on calculator. Because I realize that not all the students know the certain shortcuts of calculator. Not all of them I will teach you today, but as we proceed to solve the questions, I will automatically teach you such things. All right. Starting with time value of money, in which the first thing we will try to find out is the present value, future value, or the present value of single sum. Which means, let me tell you what, everyone. Suppose you have 200 rupee of a cash flow today. When I say today, it obviously means that it is already a present value, which means if you have 200 rupee today, rate used for compounding or discounting, if that is 10%, then what will be the future value of this rupee 200 at the end of 5th year? Is the simple question. I am giving you 2 minutes to first work at your own. I don't want to teach anything right now. Obviously, na yaar. Give some burden to your brains, give some work to your brains. Answer. Even if you don't give me an answer, you should have the answer in your notebook, is what I want to tell you. Sir, very basic. Let us try to do the things both on the calculator and through the formula, right? When we stand at CA final level, both the things should be very much clear to us, the calculator and the maths or the formula. Sir, first of all, the given situation should be 100% clear to you. What is the situation? You please don't write, because I'm wondering if we have sufficient space to do it or not. Y'all please don't write. I'm trying to first of all create a chart kind of a thing out of it. For example, I have, this is 0 year, this is 5 year. I have rupees 200 over here. I want to, people in the class, find out the value of this 200 rupee over here. This is what the question is, right? Simply saying, everyone simply saying, please be here. And what is the rate? When you say rate is 10%, always know that if it is not mentioned, always know that if not mentioned, rate is always per annum, right? I will also make you people understand something related to rates if as we proceed. How to interpret the given rates, I will explain you later. For now, you can write down it is per annum. For now, you can write down it is per annum. All right, let us proceed. Sir, if you can recollect, so I'm changing the approach. Initially I was thinking that let me explain everything right from the detail. I'll explain it in detail, but I won't give you the derivation of formula. You will have to use some basic knowledge you acquired at CA foundation level and CA enter level. And now obviously, sir, do you know if I have to find out the future value, it should be present value into present value factor. Present value factor at what percent? At the rate of 10%. For how many years? 5 years. Sir, how do I find out that? So for example, if my present value is rupees 200, let me tell you how do you find out the present value factor. Let me first, chalo, let me try and teach you. This is something very obvious, but still if you don't know, let us do it once. Sir, you will have to take 1 plus r on the calculator, है ना? So let me also write down this as well. So present value factor is basically 1 plus 10% to the power 5. How do I find out future? Sorry, my bad. I just used wrong word, future value factor. Present value factor I used despite future value factor. So obviously, if I have to find out the future value to the present value, if I multiply future value factor, it will become future value. Correct. How do I find out future value factor? So obviously 1 plus r to the power n, basic formula that you know right from the childhood. Correct, which is 1 plus 10% to the power 5. How do you calculate it? Something very obvious. You must have done it multiple times. 200 multiplied by. How do I do it? Let me show you. These calculators, easy tricks, basic tricks. This is not even a rocket science. Chalo. What you have to do is that 1 plus 10%. So when you do 1 plus 10%, it is simply 1.1. When you do 1 plus 5%, it is 1.05. This is basic. When you do 1 plus 20%, it is 1.2. So you take 1.1 on the calculator. And when you do into equals to, it is basically 1.1 to the power 2. If you press again equal to, it become to the power 3. If you press again equal to, it become to the power 4. So when you do 1.1 into equals to, you have already squared it. Equal to again cube, equal to again to the power 4, and equal to again to the power 5, which means 1.611. 1 plus 10% to the power 5, which is my future value factor at the rate of 10% for 5 years, become 1.611. Let me confirm. 1.611. Sir, how many decimals do we have to take? As we proceed, I will also teach you with time which thing you will have to take for how many number of digits after decimal points. For example, don't write it down, I will give you a summary, but for now you can understand, you can know that present value factor, future value factor, all these things you will take till 3 digits after decimal points. So 1.611, because the number on my calculator is 1.6105. All right, chalo. 1 point, all right, let's proceed. 1.611. So number is not important. Whatever is the answer, be the answer. So it is like 200 into 1.611 is 322.2. Answer is not important. More important is the understanding, basically how to calculate. How did I do it on the calculator? Let me write it down very quickly. It was like 1.1. Hold on. 1.1 into equal to equal to equal to 4 times. है ना? So I hope you people would be able to understand it the way it is presented. चलो. Just a second. Cool. Sir, do we need to really understand if we are okay with calculator? Imagine that you are comfortable with calculator, so you can directly calculate future value factor like this. So do we need to still understand this? Obviously, these are so basics of AFM that these may be used at any point. In fact, this will be used at a lot of time. Cool, very easy, basic. Sir, another situation. Let me take you here. So let's assume that this time I have rupee 200 here in the form of future value. And let's assume that I want to find out the present value over here. Cool. The situation changes. That if I have a future value of rupees 200 rupees, you have to find out what will be the today's value of 200 rupee at the end of 5th year. If you have this rupee, what will be the, everyone in the class, hold on, present value. Chaliye, very quickly present it, waiting for you all to present. Super quick, super quick, super quick. What will be today's value of 200 rupee at the end of 5th year? So needless to mention, you should be comfortable with this, with this, with this, and obviously with the calculator. So in this case, I will write present value. This time I have to find is basically whatever is my future value into present value factor. Present value factor calculated at the rate of 10% for 5 years. How much is it turning out to be? 124, as people are saying in the chat. All right, let's figure it out. Sir, future value is rupees 200. How do you find out present value factor? So obviously, let me directly create a box for you, sir, and show it to you. How do you do it on the calculator? है ना? How we do it obviously is take 1.1 on your calculator, 1.1 your calculator, do divide and then do equals to कितने times? 5 times. है ना? So you take 1.1, divide 1, 2, 3, 4, 5. 1.1 divide equals to equal to how many times? 5 times, which means you have to take a rounded off till 3 decimal points with 3 digits after decimal points, which is 0.621. And when you multiply rupee 200 with 0.621, it gives me 124.2, which is obviously a correct answer. Which means, sir, these steps should be quite obvious for you. 1.1 divide equal to 5 times. You know what is something to observe? When you have to calculate future value, you do multiply equal to. And when you have to do present value, you do divide equal to. But multiply equal to is only 4 times. If it is 5, you do 4 times. It will be 10, you will do 9 times. However, divide equal to you do 5 times. If it is 5, you do 5 times only. If it would be 10 here, you do 10 times only. You don't do -1 like this. Over here, you don't do. Cool. Great. This is basic done. Next situation, annuity. Sir, single sum means there is only one cash flow. One was present value, so we made it future value. One was future value, so we made it present value. Now what you have to do is about the annuity. Do you know what does annuity mean, everyone? What does annuity mean, people? Annuity is a series of cash flow. It is not a single cash flow. For example, if I have 5 cash flows, like 5 cash flows of rupees 200 each, at the end of every year, you know what is the condition of annuity? Same cash flow after same time interval. 200 rupees at the end of first year, then second, then third, then fourth, then fifth. Matlab, after every 1 year, if I receive the same amount of cash flow, it is annuity. Sir, if I receive 500 rupees at the end of every 6 months, which means at the end of 6 months, 12 months, 18 months, 24 months, will it be annuity? Yes, it will be. Same cash flow after same time interval is annuity. Sir, can we find out the present value and future value of annuity as well? Yes. Yes. Which means, what are you trying to say? Please understand. Please understand what are you trying to say. Clearly understand. No scope of confusion at all. We will be lack of space, so you don't write down right now. Let me write down, let me complete the presentation, then you write. Suppose if I have to find out. So let me explain you the flow. The left column is for future value, the right column is for present value. So if I have these five cash flows, and if I want to find out the future value for all of them, let me do it for you right away. What will be the present value? Let us understand. The question, everyone, is chalo. The question, everyone, is what will be the future value of all these 200 rupees? Let me tell you the most important concept of the entire AFM, most important approach, I must say. In the subject of entire AFM or SFM, let me tell you, sir, if you are able to imagine the things on the timeline, you have half won it. Let me tell you, be it the most difficult question, if you are able to imagine the cash flows on the timeline, you have literally made it easy. A lot of people apply these formulas of annuity, calculating future value, present value, single sum future value, present value, but do you know where do they lack? Even if they apply formula, they are not able to imagine where on the timeline they stand. For example, here you know that present value is at point 0. You need to make it to 5th year end. This is how you do it. How you do it, still a lot of people do, but exactly on the timeline they are not clear. And being able to frame a question in terms of timeline is the most important thing, and that you will realize as we proceed. My objective of this batch won't be to make you people solve the question. My objective of this batch will be evolve you people in such a manner that you are able to think at your own to solve any question. Once I teach you how to think, my purpose will be done. You will become self-dependent to solve any question given in the situation, solve any situation given in the question. All right. Similarly, over here, we need to learn if you have cash flow at the end of 1, 2, 3, 4, 5, how do you find out the future value at the end of 5th year? How do you do it? Very simple. So it will be, sir, future value will be whatever is the amount of annuity. This, whatever is the amount of annuity every year, 200 every year, multiplied by future value annuity factor. This time it is not future value factor, it is future value annuity factor for at the rate of 10% for 5 years. All right. Now you need to understand this carefully. Some people might know it, some people might, a lot of you might not know it. Why? Because, sir, this is the example generally not in use. Even if an enter, if you recollect, primarily the questions that you have done with respect to this were NPV, IRR, etc. And in most of the question, you used the concept of present value but not future value. Even in CA and CMA final, let me tell you, lot of time, in fact, a rare time this concept would be applied. Most of the case, this will be applied. But if we get even a single question where this concept is applied, and if we miss in this concept, we will miss the marks. Imagine CA and CMA final is not about these basic things. They are about really something which is advanced. Name itself has advanced, strategic in it. है ना? So make sure that we never have to miss on such basic things even if they are rarely asked. Alright, let us proceed. Let me tell you the approach. Sir, let's ignore 200 rupee. For now, imagine that we don't have 200 rupees. We just have 1 rupee. 1, 1, 1, 1, 1. And I want to find out future value of all these 1 rupee at this point. If I find out the future value of all these 1 rupee at this point, I will automatically find out the future value of those 200 rupees at that point. So let me focus on rupee 1. Let's imagine that if I have rupee 1 here at the end of 5th year, what will be the future value of that 1 rupee at the end of 5th year? Sir, same. Array 1 rupee at the end of 5th year is same only, na? Cool. So let me now write down the calculator step on the timeline itself. Hold on for a minute. I need some space. I'm creating some space. Hold on for a minute. And thank God I said, please wait. I asked you all to wait now before writing. See this, everyone. If I have 1 rupee over here, what will be the future value of that 1 rupee over here? The same. Cool. So let us understand how are we going to do it on the calculator. On your calculator, first you will have to take 1. On your calculator, first you will have to take 1 and obviously do m plus. Let me use pink pen. Which means this one is added over here. Correct? Now I need to talk about this one. Right? Which means this 1 rupee, what will be the value of this 1 rupee at the end of 5th year? Which means 1 rupee which is there at the end of 4th year, what will be the value of it at the end of 5th year? Because I need to bring this 1 rupee over here. Which means, can I say, if I multiply 1.1 into 1, or say, let me find out a further shortcut. Hold on for a minute. If I don't teach you that, this will also work. Chalo, great, this will also work. Sir, this 1 rupee which is there at the end of 4th year, what will be the value of that 1 rupee at the end of 5th year? 1.1. So obviously I will directly take 1.1. Or if the rate of interest will be 5%, rather than 1.1, I will take 1.05 over here. Sensible? Cool. So 1.1, obviously, this 1 rupee is added in the M plus. This 1 which will become 1.1 over here is also needed to be added. So I will say 1.1 and again M plus. Sir, why M plus? Because you need to understand the meaning of the word annuity factor. Annuity factor means all these 1 rupee, all these 1 rupee which stand here, they are all done future value, and after being made the future value, they are being added, right? So this 1 rupee will remain 1 here. I have already done M plus. This 1 rupee, this 1 rupee will become 1.1 over here. So I have done M plus. Now what about this one? Sir, how much this one will be at the end of 5th year? So you already have 1.1 on your calculator now. You already have 1.1 on your calculator. Sir, if you simply do into equals to, see, right? Try the process right from the scratch. Try the process right from the scratch. 1 M plus, this is done. Sorry, 1 M plus, this is done. Then you take 1.1 M plus, this is also done. Now if you do just into equal to, you will get 1.21 on the calculator, and value of this 1 rupee at the end of 5th year is 1.21 only now, because you need to do 2 years of compounding. So 1 rupee with 2 years of compounding become 1.21, and you need to ultimately add it up. So into equals to M plus. Now if you just press equal to, you will get the value of 1 rupee at the end of 5th year. This 1 rupee at the end of 5th year will be 1.331. So just by pressing, you already had 1.21 on your calculator. Just by pressing equal to, M plus, you would be able to register this 1 rupees future value of 1.331 into M plus. Just by pressing equal to again, and doing M plus, this 1 rupee, you will get the future value over here. Just by pressing equal to, you will get the future value here, and by doing M plus, you would be able to register it. Could I, everyone in the class, explain the process? I would want you all to let us do it together on the calculator right away in the class. Sir, I want to find out future value annuity factor. What does it mean? Future value of all these 1 rupee at the end of 5th year. Sir, 1 rupee of 5th year remain over there only. Make it 1 and M plus, done. 1 M plus, done. This one at the end of 5th year will become 1.1. So make it 1.1 and M plus, done. If I do into equals to, I will be able to do the square of 1.1, and this one, if I have to take to 5th year, I will have to do square only now. 1.1 square only now. So on your calculator right now will be 1.1, correct? 1 second. So let me start. 1 M plus, then 1.1 M plus, correct. If 1.1 is already there on my calculator after this M plus, if I do into equals to, I will get 1.21. Just by doing M plus, I will be able to register this value over here. So this is also done. Just by pressing equal to, I will get 1.331. So future value of this 1 rupee at the end of 5th year is 1.331. I would be able to, just by doing the M plus, I will be able to capture that value as well. Just by pressing equal to, I will be able, I am getting 1.4641 something, which is the future value of this 1 rupee over here. Future value of 1 rupee at the end of 5th year. So just by pressing M plus, I would be able to capture this as well. So all these 1, 1, 1, 1, 1, they have been done future value like this and added to each other, the total of which, memory recollect of which, will give me future value annuity factor. Let me now do it on the calculator. While explaining, I could not. So 1m plus 1.1 m plus into equals to m plus equal to m plus equal to m plus, memory recollect is 6.105. So what is the annuity amount? 200 into what is the future value annuity factor? 6.105. What is the answer? 200 into 6.105. 1221. 1221 is the answer. Chalo, let me not map it over here. Everyone in the class, are we settled and comfortable with whatever we have learned? I would want you all to take a quick break now, right? What you have learned right now, at the end of every year, if you have 200 rupees for 5 years, what will be the future value of all those 200s? Conclusion is important. What will be the total future value of all those 200s at the end of 5th year? After the break, we will understand what will be the present value of all those 200 rupees at the end of like at 0 point. Right now you have learned future value of all those 200s at the end of 5th year. I think, pardon me, I think I used the word present value once. Let me repeat. Over here it is future value of all those 200 at the end of 5th year. Now we will learn after the break present value of all these 200s at point 0. So let us proceed to take a 15-minute break. Let us get back at 10:10. Let us take a quick 15-minute break. At 10:10, when we meet back, we will cover up rest of the part. All right. You need to confirm, you need to validate. Could I explain this to you? Sahil, could I explain this or I rather made it complicated for you? What is the status? Could I explain this to you or no? Kindly confirm once. Rest of the live people in the class, even recorded people, kindly answer. Could I really explain or no? Chali, I'll wait for your answers. Let us proceed to take a break. Let us meet back at 10:10 and then continue. All right. Bye bye. चलिए everyone, are we people in the class back after the break? बोलिए. Jitendra is here. Hi Jitendra, thank you so much for your comment. Are we back? Sahil, are we back? Can we proceed? So we have clearly understood, everyone in the class, how do you calculate the future value of all these 2 to 200 rupees with the help of future value annuity factor. Now we're going to be understanding, if we have these 200 rupees, how do we calculate the present value of this? How do we calculate present value at this point 0? So hold on for a minute. Let me think of the presentation. है ना? Again, we might have some space issue, which is why don't write it down. Let me write it down myself and then we proceed. What is the present value of these 200 rupees received at the end of every year for 5 years? All right. 1, 2, this, and on calculator, this is a very simple step, I know, because all of you have been doing this present value annuity factor wala thing on the calculator using the function of GT since very long. So I won't need much time to teach this one, but you should be logically able to understand what are you doing. That, sir, if I have to calculate the present value of the annuity amounts that I receive at the end of every period, then multiplying present value annuity factor at the rate of 10% for 5 years can give me the present value. So 200 is the amount of annuity. Present value annuity factor calculation is quite easy. How's that easy? Let me show that to you on the calculator. Sir, what you have to do? On your calculator, you have to follow this very simple step. What is simple step? Sir, 1.1. I know that I don't need to explain it. You all already know it. Please check this out. Sir, 1.1. On your calculator, take this number. 1.1 divide equals to how many times? Sir, since present value is to be done 5 times, I will do equals to 5 times, and then all I need to do is to press GT. Then all I need to do is to press GT. 1 second. Then if you do GT, automatically you get the present value annuity factor. On my calculator, 1 second. On my calculator, this is the button over here for GT. Let me do it. 1.1 divide 1, 2, 3, 4, 5. 5 times equals to, if I press GT, I get 3.791. 3.791, which means all those 200 rupees, if I want to calculate the present value, it should be 200 into 3.791, which is 758.2. But you know what is the interpretation of 3.791? It means that 1 rupee, 1 rupee, 1 rupee, 1 rupee, 1 rupee. All these 1 rupee for the next 5 years, which is year 1, 2, 3, 4, 5. What is the present value of all those 1 rupee at the end of respective year? Present value, the sum of present values is 3.791. Similarly, the future value was 6.105. And for 200 rupee, it becomes 758.2. This is the concept of present value and future value. You have learnt it in terms of understanding, in terms of calculator as well. All right. Sir, what is annuity due and what is regular annuity? Let me explain, but the formula won't be needed. Listen to me carefully. If I have my cash flows at the end of every year, see, in this example, whether I calculate FV or I calculate PV, all my cash flows are at the end of every year, at the end of first year, second year, third year, fourth year, fifth year. If that is the case, I call it regular annuity. या फिर ordinary annuity, or what can I call it? Ordinary annuity. Unlike this is annuity due. You won't need to cover it. But you should be just knowing what does it mean. Regular annuity means when all my cash flows are at the start of the year, which means start of first year is this, start of second year is this, start of third year is this, fourth year is this, and fifth year is this. Which means when I have my cash flows at the start of every year, 1, 2, 3, 4, 5. At the start of every year, if I have my cash flows, and in that case, if I have to calculate the future value or present value, I have to apply the concept of annuity due, which we do not need to cover. All right. Moving to perpetuity, the third category, and obviously an important category, perpetuity. Perpetuity word is made up of perpetual and annuity, where perpetual means forever. Till infinity, if I receive an annuity, what is it called as? It is called as perpetuity. Sir, if I receive a cash flow of say 100 rupees every year till infinite number of years, is it possible to calculate the future value? Can I calculate the future value of cash flows received till infinity? It is not possible. It is not possible. Acha, tell me one thing. At what point will you calculate the future value? Because infinity is not defined at the end of 1 crore year. No. At the end of 5 crore years. No. Infinity is not defined. Sir, at what point will you calculate the future value? You actually cannot calculate. But sir, is it possible to calculate the present value of infinite number of years of cash flows? Yes. Which means if you receive the cash flows till infinite number of years, you can actually calculate the present value of all those infinite number of years. But sir, how is it possible? Because infinite cash flows has no limit. How do I calculate the present value here? It is possible. You know why? Because the cash flow which is received, say 100 rupee of cash flow which is received at 1 crore years, because infinite is beyond that now. Suppose at the end of 1 crore year, you receive 100 rupees. What is the present value? Sir, present value is almost zero, negligible. So as I go ahead to 10 crore years, for example, the value of that 100 rupee come negligibly further zero, which means it doesn't add up to anything. Which is why it is practically possible to calculate the present value of all the future cash flows received till infinity. The formula is very simple. The formula is very simple. Formula, everyone, is A, which is the annuity amount, divided by R, which is the rate. Rate. Listen to this. R. What was R? One second. Let me update it over here. Rate of interest will be defined by R in our book. A, you know, annuity amount. Sir, simply saying 200 divided by 10%. How much is the amount in our book? It is 200, right? 200. 200 divided by 10, which is 2000 rupees. The present value of all the 200 rupees is to be received till infinity. This, everyone in the class, completes the discussion on the concept related to time value of money. Now you know the present value and future value calculation of single sum, regular annuity or ordinary annuity, and perpetuity. Done? Cool. Sir, how do you apply these concepts? That is what I will teach you now. You need to come to, everyone in the class, the concept of different types of returns. Let me introduce to you two different but similar looking terminologies. Two different terminologies. One is called as required rate of return. Another is called as expected rate of return. Very simple, easy terminologies. You need to focus on what I teach now. They are not about formulas. They are about understanding them. Sir, let's imagine your exam. The most horrible things you can actually imagine, but let us imagine your exam. You are preparing. It is the month of, so suppose you have an attempt in, you are standing 1 month before the exam. On that day, if I ask you, how much do you think you will be able to score in the exam? How much marks do you think you would be able to secure? And you say that 55. And then I ask you, but how much is minimum required? So you say 50, for example, right? So how much do you think you will be able to score is your expected marks. How much you think based on your estimate, based on your expectation, you will be able to score is the expected marks. But how much is minimum required? Are you required, like minimum marks you require? Similarly, there is one more student. I asked him, how are studies going on? He said, no, not well. I said, why? Because he said, I took the classes from some other faculty. Jokes apart, right? So I asked him, how much are you expecting to score? He said 35 around, because I could not prepare well. That's what he said, right? 35 marks is what he expecting he would be able to score. That is his estimate. Does that, and then I asked him, what is the minimum you require to pass it? He said, minimum I require as per the exam rules are 50. That is the difference between how much is minimum, how much minimum is needed, and how much you expect. Similarly, think about the returns. You are holding a share of TCS. I'm asking you, how much are you expecting a return from this share? Please listen to the story carefully. I'm asking you, how much do you think you would be able to make out of TCS? How much you are expecting to earn? What is your expected rate of return? What is your estimate of return? So you say that, sir, right now the price of TCS is approximately 4,000. I said, okay. And then you say that I'm expecting this price to reach to 4400 in a year. I said, fine. And you are also expecting that TCS will distribute a dividend of 100 rupee at the end of first year. Fine. So when you stand today at 0 point, at the end of first year, you are expecting certain things. Let me show it to you on the timeline, first time in any batch. Such a basic concept, but I personally believe that timeline is everything. Do you know what is the point of creating this face? Everyone. If I create a face here, it means you're standing at this point. All right. It's very important now where on the timeline we stand. You're standing here. Sir, at this point, if I ask about the TCS price, at this point, I call the price to be P0. Suppose it is 4,000. I ask you, what is the price you think you will have after a year? So you are expecting it to be 400. I ask you, what is the dividend distributed for this period? I ask you, for this period, how much do you think will be the dividend? So you say that in your expectations, one second, hold on. In your expectation, dividend for this entire period will be rupees 100. So again, back to the story. We were standing here. Yeah, I don't like everything in black. Wait. Chal. Great. When you stand today, back to the story, if I ask you how much do you think you would be able to earn in the entire year, you said I will be able to earn in two ways. First, I will make the capital gain. I said how much? So you said you will make a capital gain of everyone. You will make a capital gain of. Don't listen. Don't write it now. I need some space so that we manage it at the end. Sir, you are going to make a capital gain of 4400 minus 4,000. Correct? So your first earning will be 400 rupee of capital gain. Your second earning will be 100 rupee of dividend. So you are going to earn a total of 500 rupees on this investment. Now I told you, whenever you want to calculate the return, there is the simple formula. In the denominator comes what is invested and in the numerator comes what is earned on that amount. Sir, if this is if this is the return I have made, it becomes numerator, denominator becomes what I have invested. So by investing 4,000 rupees, what all have I earned? I have earned this 400 rupee of capital gain and this 100 rupee of dividend, and total 500 rupee when I earn on an investment of 4,000, 500 divided by 4,000 gives me 0.125, and as I said, it is equals to 12.5%. Correct? This is such a basic thing. Huh? So you remember as a kid, you used to multiply 100 to any percentage. So by multiplying 100, it becomes 12.5. If you don't multiply 100, it becomes 0.125. So you can think manually, like you can think intuitively. Now 0.125 is equals to 12.5%. Expected return is how much do you think you will be able to make based on your estimates, and formula remains very simple. If I have to officially create the formula, it becomes P1 minus P0 plus D divided by P0. Common sense. P1 minus P0 tells you how much is capital gain, D tell you how much is dividend, and the total tells you how much have you earned in total. How much are you expecting to earn in total against an investment of P0 that you have made? So denominator has amount invested, numerator has return made on that investment, and finally the percentage expected rate of return. Relate it with their example. How much marks do you think you will be able to secure this? How much return do you think you will be able to make this? But how much marks do you need? That does not depend on your expectation that I think I will be able to make this. How much marks do you need is different thing. Similarly, how much return do you need, how much return you require is a different thing. If I ask you how much return you are planning to make from TCS, you will say 12.5%. But then I ask you, how much do you think you need? So you might say that, sir, return actually depends. People in the class, listen to this. Return depends on the risk taken. For example, if you invest 100 rupee on Government of India bond, you might need just 8%. If you invest 100 rupee in the share of, for example, HUL, or in the share of DMart, which is relatively a less riskier asset, you might need 10%. Less riskier means less riskier as compared to TCS or Reliance. The same 100 rupee, if you invest in the share of Reliance, you might need to earn 12% because of higher risk, and same 100 rupee, if you invest in Bitcoin, you might want to earn 25%. The more risk you take, the more return you feel like earning, because otherwise, what is the point of taking risk? Tell me one thing, if you receive the same 10% on Bitcoin, will you invest in Bitcoin or you will continue to invest in HUL? If you receive just 8% from Reliance, will you invest in Reliance or you will continue to invest in Government of India bonds which are risk free? The point is, you take risk only when you feel like earning more return out of it, meaning to say, you take risk only when you get a higher return. Which means, can I say my return is being dependent on risk? How much I need to earn out of something depends on the risk taken. Required is how much I need to earn, that depends on risk I take. Expected means how much I think I will be able to earn, that depends on the price movement. Suppose because of COVID the market is expected to fall and that the share price will fall to 3600 with no dividend distributed. Share price fall to 3600, no amount of dividend, return will be 3600 minus 4000 divided by 4000. No dividends, which means expected return is minus 10. I am expecting some political instability, one government to win, another government to fall, right? And one party to win, another party to fall, and because of which I'm expecting the market to fall. My expected rate of return this time is negative 10%. Everyone, my expected rate of return is negative 10%. But does that mean my required return is also negative 10? No. I have taken the risk by investing in TCS. I am requiring to earn 12%, but I am not expecting to earn that much. I won't be able to earn that much. It seems I would be able to earn only 10%, but still I require to earn 12% because I have taken the risk. Are you people able to differentiate what you require to earn depends on the risk you have taken. But how much you expect, how much you estimate you will be able to earn, which is your expected rate of return, depends on the expected price movement, whether P1 will be 4400 or 3600, which can be both positive or negative, but required rate of return is always positive because I would want to earn a positive return. I need a response. There is this student called as Pacific. What's your actual name? I am a CMA final student. Tomorrow I have exams and your revision lectures are helping me to revise the concept. Thank you so much. Thank you so much. Everyone. So chalo, we are back. With the help of example, we could clearly understand required and expected. Let us take it ahead and understand how do you calculate the required, because expected you have learned to calculate. This is how you calculate expected, right? Acha, I think I missed to tell you today's lecture. Today's lecture will be for 3 hours. Matlab, we are going to have this lecture for till 11 a.m. All right. Next thing, the next lecture is going to be day after tomorrow. So first 2-3 lectures will keep with one day gap, post which will continue. So today is Wednesday. Next lecture is going to be on Friday. Then the lecture is going to be on Monday, and then we continue as it is. All right. So 3 YouTube lectures will going to be for 3 hours each, and then we are going to increase the time to 4 hours from 8 to 12 a.m. This is going to be the flow. All right. Chaliye, let's be back. Sir, let us understand how do you calculate required rate of return. As I said, your required rate of return depends on the risk taken. Sir, for example, let me figure out if this is the right point to explain this or not. Sahil, I would want you to change the word. You said more risk, more return. Expected nahi, more return required. If you take more risk, you require more return. I know the word. So basically English is quite confusing. In one sense, in a sense you are saying correctly. If I take more risk, I will expect more return. But you don't use the word expected, use the word required. Because expected has some other meaning. How much I am expecting I will be able to earn. How much I think I will be able to earn. How much I am estimating to earn. That is expected. If market goes up, I'm expecting a positive return. If market goes down, I'm expecting a negative return. But I always require to earn a positive return. Right? Correct. So come here. Allow me a minute. Let me find out if we should understand this concept here only. Chalo. Correct. है ना? आ जाइए. Sir, talking about how do you find out the required rate of return? है ना? For this, you need the understanding of cash flows as well. So let me first of all take you to the cash flows wala concept, and then I will take back here to you. But for now, you are clear how much I require to earn based on the risk taken is required. And do you know what the most important line? The most important line. Do you know what is the use of required rate of return? Required rate of return, which is also called as opportunity cost, it is used as a discounting rate. Which means, do you remember all these discounting, compounding that we have done in the time value of money? Sir, you might ask, sir, how do you find out this discounting rate? How do I know that this 200 rupees, sorry, how do I know that this 200 rupees to be discounted at the rate of 10%? When we proceed in the chapters ahead, you will learn, not now, but when we proceed in the chapters ahead, you will learn that 10%, which is used as a discounting rate, comes actually using the concept of required rate of return. If I require 12%, I will discount using 12. If I require 15%, I will discount the cash flows using 15. All right. So I will teach you this concept later on. The basics are clear, but I need to first teach you what are different types of cash flows. All right. Hi sir, your classes are ultimate. Your class is ultimate solution to AFM. Get to see you after a long time. Hi Prerna, I hope you are doing great. Are you all set? Chaliye. All right. Back to understanding types of cash flows. See, obviously, finance is all about cash flows. A lot of time we will have to talk about cash flows and cash flows, right? For example, in Inter, you have done the concepts of NPV IRR. They were all based on cash flows. In CA final, CMA final, you will do the concept of valuation, right? In the subject, in the chapter of fixed income chapter I told you about, in the index bonds wala chapter, bonds related chapter, even in that chapter you will talk about cash flows, right? So we need to, when we will do capital budgeting, the cash flows from the project, we will talk about cash flows. So in the AFM it is all about cash flows, and there can be two types of cash flows: nominal cash flows and real cash flows. Let me explain that to you with an example. Prerna, results ka tension. Don't worry about results. You have done your part really well. Now it is his part. I mean to say God. Now it is his part. He will take care of it. We need to happily accept whatever it turns out to be. All right. If you are listening to me. Anyways, great. So everyone, let us be back to understand nominal cash flow, real cash flow. All my live and recorded student, listen to me. Suppose I am starting a project. I'm starting a project. I want to sell a particular product. I want to sell a particular product of which I am expecting that at the end of first year I will be able to sell 100 quantity. At the end of second year I will be able to sell 110 quantity. At the end of third year I will be able to sell 120 quantities. Right? Sir, at what price? So obviously, price of the product today will be different. After a year will be different. After one more year it will be different. I am estimating. So for example, price today, I know for that product is rupees 50. Do you agree that in case of AFM or in case of financial management subjects, we generally assume the cash flows to be occurring at the end of the year, right? So is this price of today relevant to me? No. What is relevant to me will be the price of at the end of first year, at the end of second year, at the end of third year, right? So if I take the price which is today, with the help of inflation, I can find out the price that will prevail on the future date. So for example, price, hold on. Price without the effect of inflation will obviously be If there is no inflation, assuming there is no inflation, price will obviously be 50-50 only. Obviously, na, same price is going to continue, assuming there is no inflation, because inflation itself means what? Change in price. So price without inflation effect will be same every year. And if you look at the actual price, if you look at the actual prices with the effect of inflation at the end of every year, let us assume the inflation to be 10%. Let us assume the inflation to be 10%. If price of an asset is 50 today, after a year it will be 50 plus 10%, which is 55. One second. Just one second. Let us assume that inflation to be 10%. So price which is 50 today, at the end of first year it will be 55. After first year it will be 55 plus 10%, which is 60.5, right? At the end of third year, but for second year it will be 60.5. At the end of third year it will be 60.55. What I am trying to teach to you is that my actual cash flows, everyone, the most important line, the basics have been built. I am talking about three types of cash flows which I have. All right. One, how much my actual cash flows at the end of year 1, 2 and 3 be? Sir, that will be based on my actual price and actual quantity. Suppose if I sell 100 quantity at a price of 55, I will get my actual cash flows. 110 quantities sold at a price of 60.5, I will get the actual cash flows, and 120 into 60 will give me actual cash flows. But do you agree these cash flows which I will actually receive automatically includes the effect of inflation, which means this 55 includes the effect of inflation, 60.5 it includes the effect of inflation, 66.55, I think it was 66. 66.55 includes the effect of inflation. So such cash flows which include the effect of inflation, which are the actual cash flows you will receive, are called as nominal cash flows. These are the real world cash flows. All the real world transaction will take place at this cash flow. What you will receive at the end of second year is actually this number, this into this. And these are called as nominal cash flows. They automatically include the effect of inflation into it. However, if you eliminate the effect of inflation, if you remove the effect of inflation, if you consider the real prices, if you consider only 50, don't consider inflation, and then if you calculate the cash flows, that this quantity, if sold at a price which existed today, what will be the cash flows? Which means those cash flows which does not include effect of inflation are called as real cash flows. Could I, everyone, explain which means? Let me put it up over here to you. Sir, this is 1. This is 2. So nominal cash flows will be quantity multiplied by 2. Wait, ऊपर लिखते हैं. We'll write it over here. Will be quantity multiplied by 2, but real cash flows will be quantity multiplied by 1. Correct? I sold this quantity at this price, which includes the effect of inflation, is nominal cash flow. These are real cash flows. I hope this is 100% clear. But sir, why am I learning all this? You know why? I know your actual cash flows will be this. But why are you learning? Sometime examiner will give you this cash flows. So the most important part is that if I have nominal cash flows and you know the cash flows are to be discounted. If I have nominal cash flows, they are to be discounted using a nominal rate of return. Oh, you remember discounting rate used to be the required rate, everyone. So if the cash flows are nominal, your required rate of return is also the required rate of return being used is also nominal. However, if the cash flows are real, the required rate of return being used is also real, which means just like the rate are nominal and real, just like the cash flows are nominal and real, even the rates of return are nominal and real. We will talk about it. For now, you know what are the real and nominal cash flows, and you know that to calculate PV of nominal cash flow, nominal discounting rate is used. To calculate the PV of real cash flows, real discounting rate is used. But sir, is it possible to convert a real cash flow into the nominal one? Yes, very easy, very easy. Sir, listen to this carefully. If I want to convert the nominal cash flows, suppose at the end of third year, what will be the nominal cash flow of at the end of third year? So I am calling it N. At the end of third year, if I want to find out the nominal cash flow, I will have to simply take the real cash flow of third year. One second, let me put it in. Suppose N is 3 in our case. I want to find out the third year's nominal cash flow. Take the real cash flow of third year. Do you agree? In this cash flow of third year, which is based on this price, in the real cash flow of third year, which is based on this price, if I want to convert it to nominal, basically I will have to give the effect of inflation for 3 years, right? How do you give the effect of inflation? Very simple, multiplied by 1 plus whatever is your inflation rate, to the power 3, basically to the power n. So take third year's cash flow, give the effect of inflation. Take third year's cash flow, give the effect of inflation for 3 years, you will automatically get the nominal cash flow at the end of third year. Please let us understand, you are not doing compounding or discounting. This cash flow is already at third year only. Don't think that you are compounding the cash flow to third year. No, no, no. The cash flow is already at third year. You are just giving the effect of inflation for 3 years to make it the nominal cash flow of 3 years. And let me tell you, you can confirm it. Chalo, let us pick the calculator and you will realize it yourself. Sir, what is the real cash flow for third year? 120 into 50. Make it 120 into 50. 6,000 rupees is the real cash flow for third year. Let us do 1 plus 10% inflation for 3 years. Let us do 1 plus 10% inflation for 3 years. So 6,000 multiplied by 1.1 multiplied by 1 second. Please do 6,000 into, I am not doing it on the calculator for you. Please do 6,000 into 1.1 to the power 3. I am doing it myself. It becomes 7986. Correct? Let us just confirm once. Nominal cash flow of third year. Let us just confirm once. Sir, 120 quantities sold at a price of 66.55. It is 7986, the same number. I hope I am able to logically convey to you everyone how is a nominal cash flow converted from real through this method, and how do you understand them over here very easily, very logically. Done? Cool. Only this much is needed now. We will go back to that topic. Sir, why are you switching the topics from here and there? Let me tell you, at the time of understanding it first time, like you are doing it right now in the class, we are switching. But at the time of revision, things will be in flow. Things will be in flow that right now you focus on learning this, right? Let me explain you. At the time of revision, you don't have to switch from here and there. You will automatically learn what are the different types of returns. You will say, okay, it is required rate of return, it is expected rate of return, internal rate of return. How to use these rates to discount? So you will learn time value, and then over here you will learn to discount them over here. So at the time of revision, it will be all in flow. It is right now that we are switching from here to there. All right. All right. So let's be here. Let's be here, everyone. Let us proceed to understand. So we are clear with converting the cash flow from nominal to real. Now you need to understand, if the cash flow is real, the rate should also be real. If the cash flow is nominal, rate should also be nominal, and that you will be able to understand through this, everyone. How much you require to earn? How much you require to earn actually has three components. Component number one, component number two, and component number three. How much you require to earn actually has three components. All right. First is real risk-free rate. Real risk-free rate means if I invest in the market, है ना, फॉर एग्जाम्पल ऑफ रिस्क फ्री सिक्योरिटी इज गवर्नमेंट ऑफ इंडिया बॉन्ड या फिर यूएस ट्रेजरी बॉन्ड, रेस्पेक्टिव कंट्रीज गवर्नमेंट बॉन्ड. इफ आई इन्वेस्ट इन इंडिया, सपोज my risk free rate that government of India bond gives me is 8%. So as I said, what you get in the actual world is always nominal. Didn't I say this for cash flows? The cash flows you will actually make, the cash flows that you will actually make are nominal. Real are to be calculated by removing the effect of inflation from it. Similarly, suppose what you are going to get from the government of India bond is 8% of fixed return. But in that return is automatically included a inflation premium, an inflation premium. I am not going to get into the details of it considering the hours we have for this batch, right? I will try to say that, sir, 8%, which is the rate of return, risk-free rate of return, is already a nominal rate. This is a nominal rate. So you will automatically understand that, sir, nominal, which means something which is the effect of inflation included into it, right? Which means other than inflation, whatever is the return you will be able to earn is real return. Sir, government gives 8% return nominal. You went to the market to understand what are the inflation, what is the inflation in Indian economy. You realize that inflation in Indian economy is 3%. So if 8% is the nominal rate of return you are earning on government of India bond, 3% is inflation, how much you would be able to earn in real terms? What is the real risk-free rate of return? 5%. Which means, now listen to my line very carefully. If you don't take any risk, which means it is risk-free, and if you don't want to include the inflation, how much is the rate of return? You should be earning 5%. But since my economy has inflation, so I would want to earn the inflation premium. देखो, premium means additional return. Premium means additional return. So this additional return you need because my economy has inflation. So 5% you were earning if you don't take risk and if there is no inflation. But since there is inflation, I would want to earn 3% more. Even if I don't take any risk, I am taking, my economy has inflation and I would want to earn 8%. However, for taking extra risk, you need extra return. I've spoken to you. If TCS has risk, You will earn extra return. If Bitcoin has more risk, you would want to earn further extra return. So how much is the additional return premium for taking the risk? For example, 2%. So no inflation, no risk, 5% I want. Without any risk, if there is inflation, I want 3 more. But if there is actually a risk, I want 2 more, making my total return to 10%. What I want to tell you is that this your required rate of return is made up of 3 components. What is the real risk-free rate in the economy? What is the inflation premium? And what is the risk premium? And depending on the cash flow, depending on the nature of cash flow, you decide which components will be included. If my cash flows are nominal, my rate should also be nominal, matlab inflation premium will be included. But if the cash flows are real, since the cash flows does not include the effect of inflation, even my rate should not include the effect of inflation. Both will be real. They should be aligned. Both should either be nominal or both should either be real. Am I able to, everyone in the class, explain to you this simple concept? We are trying to cover the things with real depth so that you don't have to mug up the things. If any doubt, you may please ask, everyone. The topic is not yet over. The topic is not yet over. So let us do one thing. Let me complete the topic and then you ask the doubts. All right, listen to me. Sir, first thing, don't assume that we will have to literally add the rates. That real risk-free is 5%, inflation is 3, and additional risk premium is 2. So don't add it simply to make it 10%. How do you add them to each other? That we will learn later on. But right now your focus should be what will be the components. Everyone, let me give you the most comprehensive chart beyond which you won't have even a single doubt to discount any situation, to discount any kind of cash flows. You won't have any doubt. Let me proceed with it. Sir, let me present. Hold on for a second. Wait. I need to ensure the beauty of presentation as well. See. Chalo. Sir. Fazal Sheikh, all the best. You are studying from the West. Chalo, aa jao. Everyone, sir, if the cash flows are real, which means common sense, apply common sense, everyone. If the cash flows are real, which means effect of inflation is not included, which means can you logically understand to discount this cash flows? I cannot include inflation in my rate. Now you would be able to relate. The objective was explaining in this manner was this. This 50, 50, 50 for all 3 years price does not include the effect of inflation. Can I discount it using a rate which has inflation? Imagine there is no risk. Imagine there is no risk to ignore this. Imagine there is no risk. Therefore, you ignore this. But the choice is whether to discount at 5 or whether to discount at 3. Sorry, whether to discount at 5 or 8. 8. Sir, since the inflation is not included in this price, the discounting rate also should not included. The inflation should not be included even in the discounting rate. Hence, I will discount it only using the real rate. So let me now explain. If the cash flows are real, right, this is not included. Now the real cash flows will either be risk-free or risky. If the cash flows are risk-free, take only this rate. But if the cash flows have risk, see, I have invested in a project. Imagine that I have invested in this project. The project does not include the effect of inflation, real, but the project has a risk, right? It may work, it may not work. So don't confuse between inflation and risk. Risk is that the project might work, might not work. The price estimate I have made is without inflation, which means the project is real. The cash flows are real, but the project is risky. In that case, discounting rate will be real risk-free rate, but plus additional premium for taking the risk. Hence, the rate will be real risky rate, real cash flows, but rate for a risky project. So let me now make you people write down. Real cash flows and risky cash flows rate will be real risk free rate. So real risk free rate, everyone in the class, is just 1. आपको सिर्फ 1 लेना है. Correct? If the cash flows are real, does not include the effect of inflation, but the cash flows have risk, you might never get them, it has uncertainty. So in the real risk free rate, I will add risk premium. Means for taking the risk, I will need this much above the real risk free rate. So my rate will be called as real risky rate, which will be simply 1 plus 3. Yeah, let me write it down. Let me write it down in a simple manner. Wait. 1 plus 3. Suppose this time the project has the effect of inflation, which means this time, please understand, this time I have considered my cash flows including the effect of inflation. If my cash flows have the effect of inflation, and if I discount these cash flows, then obviously I can use a rate which is nominal. Since the cash flows has effect of inflation, even my rate can have the effect of inflation into it. The things should be aligned. And hence I can say if the cash flows are nominal, the rate will always include inflation, premium rate will be nominal. However, if the cash flows are risk-free, I will use nominal risk-free rate. And if the cash flows are risky, I will use nominal risky rate. 1 second, I will use nominal risk-free rate. And here it will be nominal risky rate will be 1. This I always want to earn. Now depends on which risk you have, you add that. 1 is always there, right? So I will have 1. But since the cash flows are nominal, I would want to earn 2 as well. My required rate of return will be 1 plus 2. And since there is no risk involved, the cash flows are certain, I will 100% receive them. There is no risk, I don't deserve to earn this, I will not add 3. In the third case, I would want to earn, obviously, since the cash flows are nominal, effect of inflation is there, I would want to earn 2 as well. Plus. Since there is risk, I would want to earn 3 as well. Because of taking the risk, I would want to earn on my investment third part as well. And hence you decide which all component will be there. It will be 1 or 1 plus 2 or 1 plus 3 or 1 plus 2 plus 3, depending on the nature of cash flows to make your required rate of return. Let me tell you, this concept with such a clarity is not even being explained even in a lot of regular batches. And I know in this batch, those who are buying it, there will be a lot of students who have already done their regular batches. They are taking this batch in the form of faster batch. And then I can tell you, you might have never read these things with this clarity. अभी यहाँ पे last cheese that I would want to teach you is that don't add them. Don't literally, 1 second, I'm changing it because you will add them otherwise. I'm writing and 1 and 2, 1 and 3, 1 and 2, and 3. Because if I don't write and now, you will add them. I don't want you all to literally add them like 5 plus 3 is 8. No, no, no. This is not how you do it. We just need to understand that we need to include both the components. Please confirm, could I explain? Sahil, are you settled? Sahil, this multiplicative effect we are going to understand tomorrow, but are you settled with whatever has been taught? Are the concepts really clear? Kindly confirm. Everyone, please. Rest of the people in the class, all my live students, recorded students. Inflation can be even on risk-free investment. Suppose I invest in a project. This is a project in which there is no risk. 100% I am going to earn this quantity. 100% I am going to sell this quantity. And 100% I am going to receive this price without inflation, I am saying. Right? Which means the project is risk-free because 100% I will earn. However, with the effect of inflation, I will receive the cash flows of 55, 60.5 and 66.55. With the effect of inflation, I will be earning these cash flows because there will be inflation. There is no risk. I will 100% receive my money, but there will be inflation in the economy now, which means the cash flows are risk-free. The cash flows are risk-free, but they have the effect of inflation. Hence, inflation is there even for risk-free return. Inflation is there even for risk-free return, which is why I'm saying nominal risk-free rate. Nominal means inflation effect is there, but the cash flows are risk-free. Hence, only this is not included, only 1 and 2 are included. Alright, so we are clear with in conclusion. Required rate of return is used as discounting rate to discount the cash flows, which means cash flows and rate are linked. Now, rate exactly which rate to take as discounting rate as required rate of return depends on the cash flows. If the cash flows are real or nominal, or if the cash flows are risk-free or risk-free. Nature of cash flow, rate will be decided accordingly, component will be decided. This is the conclusion. Alright, so we are all set for the day. You have very clearly learned what is required, how much you need to earn depends on the risk you take, what is expected, how much I feel like earning based on my estimate, based on how will the share price move, has nothing to do with the risk. Even if I take risk, share price might go down. It depends on the economy now. COVID, market falls because of COVID. Expected is negative, but I have taken the risk. I want a positive return. Required is positive. All right, this is clear. Time value of money, entire concept is clear. Types of cash flow till this point is clear. Now onwards, we will continue in the lecture tomorrow. Not tomorrow, day after tomorrow. All right. So I hope everyone in the class, the lecture made sense. You all liked the lecture. I will attach the link to purchase this batch in the description of this video. Right. You may kindly put up your comments in the comment section of this video to give a genuine feedback as to did you people like the lectures. All right, take care everyone. Thank you so much for being here live. Everyone who was live, thank you so much. Recorded people, thank you for watching it up. I'll see you in the next lecture. Bye bye, take care, and stay tuned on YouTube and Telegram for all the related updates related to this batch. All right, take care. Bye Sahil. Everyone else who's live, bye bye everyone, take care.